A survey has revealed that South Africa's youth is in need of increased access to responsible credit and enhanced financial literacy. This is reflected in the first quarter Consumer Default Index, which tracks behavior around mortgages, credit cards and retail accounts. The index highlights that the financial affluence segmentation has dropped from 21.9% to 16.8%. Head of Commercial Strategy at Experian, Jaco van Jaarsveldt, speaks to us about this. Good evening to you, Jaco. An interesting finding here. So do talk us through the main inputs of this particular index. It is not just about the South African youth, but the broader spectrum of economic participants.
That's right. Thank you for having me. I think the most important thing from the index is that there's a clear differentiation between those that have access to credit and then the youth that is generally excluded from credit due to structural changes in the way that credit is granted. And I think to start with, where does the credit consumer that have access to credit find themselves today? We all know the consumer is struggling, and the consumer is struggling due to high cost of living, due to high interest rates, and it's specifically those consumers that have access to secured lending products that are struggling the most. And we specifically see some significant distress from a consumer default index that measures the rate of first payment default, first time ever default for consumers, being most felt in consumers that have access to home loans and vehicle loans. And that's typically your most affluent segments of the market when measured based on the Experian financial affluent segment. Now, that is the top end of the market that have access, and then you've got the youth that's currently finding it more and more difficult to gain access to credit, simply because the way in which credit granted has fundamentally changed pre and post COVID. And where historically a credit participant would have started their credit journey with a small retail loan, with the retailers being the first port of call. And we did some analysis that showed out of every 4 people that out of 10 people that start their credit journey, 4 of them started with a retail store card. And of those, 80% went on to banking products and to secured lending products, which is an indicator that the small loan trains and teaches the consumer, and specifically the youth that gains access to these type of retail loans, to manage credit effectively. And post-COVID, the retailers stopped lending. So we're now caught in that conundrum where there's less supply than demand, which forces us to look at things very, very differently going forward.
What's also of interest is whether the matrix itself that is currently used creates a serious barrier to entry. As you've just explained, the transition from a small credit loan or even a retail store account progressing into bigger investment products, there is a bit of a gap within the South African system currently.
There definitely is. And post-COVID, what we've seen is the retailers are granting credit roughly 40% lower volumes of credit pushed into the market from a retail store perspective, which from a quantum perspective, the retailers were by far the greatest provider of credit to first-time credit applicants in the market. And they operating at between 30 and 40% less credit into the market, specifically targeting first-time credit entrants, which has resulted in new credit flow from these performing retail accounts into the banking sector dropping off, and the banks now overextending existing customers' credit. And that's where we see the top end of the market have been overextended. They had home loans, they had vehicle loans, they've been given high credit limits, more personal loans, and they're finding it distressful now. So we need to find a way, and as an organization, what we're looking at is finding routes through the use of alternative data mechanisms to fill that gap and to create access to finance to a broader population.
On the default side of things in this index, what picture does it paint then of the overall financial health of South African citizens in current day economic climate?
The South African consumer, especially those exposed to interest-bearing facilities, is finding it very difficult going at this point in time. And unfortunately, that is, if you think about, there's 2.3 trillion rand of outstanding credit in the market. 12.5% of South African consumers hold 80% of that debt, sits in the hand of 12.5% of total of consumers. And those consumers are under most financial distress at this point in time. And the only way that distress changes is a significant reduction in interest rates. 25, 50 basis points at the level of debt that these consumers find themselves, we can have a prolonged term of reduction in interest rates to make a material difference in the distress that they're feeling.
Definitely not a pretty picture. Jaco van Jaarsveldt, thank you so much for your time from Experian, discussing the latest index that measures behavioral economic activity in the South African economy.